And in 2005, copper broke out of that range, and in 2 quarters, it quadrupled in price and then lived in a new reality subsequently. Now it's breaking out again to another reality. Lead did the same thing. In other words, when it finally decided in 2007 on its own merits to break out of a multi-decade old reality, it quadrupled in a matter of a couple quarters. Silver is now, by our metrics, the spread chart versus gold, especially saying, okay, I'm out of here. We think silver is highly likely to go, I think personally, my own positions, which I expose in the report at the end in a disclaimer, is likely to see, $200, and you might even see it within the next handful of months. In other words, within a couple quarters of that breakout. So put your seatbelt on and don't expect normality.
Silver is not just moving higher, it is accelerating in a way that few markets ever do without fundamentally repricing themselves. In 2025 alone, silver is up roughly 150% year-to-date, pushing decisively into new all-time highs and recently printing $72.43. What stands out is not only the magnitude of the move, but its persistence. Over the past week, silver has repeatedly advanced through prior resistance levels that once took years to overcome, closing higher almost daily and forcing short-term skepticism out of the market. This is not the behavior of a crowded trade or a speculative spike. It is the behavior of a market that has begun to reject its old valuation framework entirely. Michael Oliver's work focuses less on headlines and far more on structural signals, and those signals are now converging with price. His analysis suggests silver is exiting what he has long described as a multi-decade old reality and entering a new one, similar to what copper experienced in the mid-2000s and what lead experienced shortly thereafter. Oliver argues that when markets finally break free from decades-long ranges, the adjustment is not gradual. It is fast, disorderly, and often violent to the upside. Based on the metrics he is tracking, silver's recent breakout is not the end of the move, but the beginning of a much larger repricing phase that could carry into the first few quarters of 2026, with $200 increasingly appearing as a conservative waypoint rather than an extreme forecast. What makes this moment especially compelling is the broader confirmation Oliver is seeing across related markets. He is closely watching relative performance charts that compare silver to gold, gold to the S&P 500, and mining equities to the broader equity market. These spreads are no longer drifting sideways. They are breaking out decisively. Similar setups preceded explosive upside moves in copper and lead when those metals abruptly abandoned decades of range-bound trading. In Oliver's framework, silver is now sending the same message. The market stayed mispriced for too long, and the correction phase is underway. In this interview, Michael Oliver lays out why silver's breakout may only be in its earliest phase, why silver miners could outperform dramatically, and why a delayed but severe stock market reckoning may ultimately amplify the move in monetary metals. If you want to understand how these signals fit together, and why Oliver believes normal market behavior should not be expected going forward, stay with us, and make sure to like, subscribe, and share this analysis with anyone serious about capital preservation and asymmetric upside.
A couple months ago, we adjusted I knew we'd get the 60, I thought we'd get the 60, 70 by the end of the year, but ultimately it is not a target. I think we've begun a phase in silver that we've explained to our subscribers over the last handful of months is likely to be a jolting one that takes silver to what we call a new reality, meaning not just doubling the price, but, more likely quadrupling or more the price very quickly, meaning within 2 quarters, thereabouts. The signal that generated that was not the fact that the net trend of silver and gold is positive. They've been positive for a couple of years. They zigzag, but, it's been net trend positive. So it's not that issue. It's the issue of the relative performance relative to, one, the stock market, meaning a breakout that is clear, technically speaking, in which the performance of gold, for example, versus the S&P is no longer a duel, which for the last 10 to 11 years, if you looked at a spread chart of gold divided into the price of the S&P, you'd see this basing pattern with ups and downs within it, which case gold outperformed for a year or two and then pulled back some. And, so but basically sideways, where it was basing relative to its performance to S&P. It broke out of that pattern in November. And now it's 1 month later and we've gained hundreds of dollars and the spread has continued to explode. But also when we analyze gold miners, gold and silver miners, like let's say GDX or XAU, and divide it into the S&P 500 and plot the same chart going back a dozen years, lo and behold, it broke out also in November, meaning, which place should I be, the U.S. stock market or gold and silver miners? Well, it said gold and silver miners. Well, they've roared since November. They've been roaring before that, but this thing said something just began. This is a big metric. I mean, you don't build a base that's 11 years wide, clearly defined with multiple highs that hit the same sort of level, and you can draw a line, anybody could, and you break through that. That's a breakout. It's fresh. And silver did the same. But the other thing that we thought was more important for silver is that it broke out versus gold. Meaning that if you want to allocate assets to monetary metals, fine, that's what these charts tell you to do. But within that complex, you want to preference silver. It's likely to lead. Silver's also broken out of its what we call the idiot range, which it's been in for 50 years. $50 for $4, $50 back down, 50 years in a range, an old normality. We showed in reports a couple months ago a similar situation in copper and lead that had prevailed back in the 70s through 2005 to 2007. It's like multiple decades of range-bound action by both those base metals. And in 2005, copper broke out of that range, and in 2 quarters, it quadrupled in price and then lived in a new reality subsequently. Now it's breaking out again to another reality. Lead did the same thing. In other words, when it finally decided in 2007 on its own merits to break out of a multi-decade old reality, it quadrupled in a matter of a couple quarters. What's going on here? Well, it's when a market discovers, oops, I made a mistake. I shouldn't have been here that long. Boom. Markets make mistakes. They're not rational all the time. And anyway, silver is now, by our metrics, the spread chart versus gold, especially saying, okay, I'm out of here. We think silver is highly likely to go, I think personally, my own positions, which I expose in the report at the end in a disclaimer, is likely to see, $200, and you might even see it within the next handful of months. In other words, within a couple quarters of that breakout. So put your seatbelt on and don't expect normality. We examine platinum, palladium, and all the other components of the Bloomberg Commodity Index monthly, technically examine them. And platinum, I know a lot of people like to link it to gold. But unfortunately, or fortunately, whatever, the reality is that if you go back decades and decades and look at platinum and look at gold, they do not correlate well. There have been times when they do, but there's also been times when the Bloomberg Commodity Index correlates to gold. So, you can't say corn is like gold, okay? You get the point. So platinum broke out by our metrics a handful of months ago and has since roared. But it did it pretty much in sync with the Bloomberg Commodity Index and, let's say, the action of copper, for example. So we think quietly it is a precious metal. It is not a monetary metal. And that it's not just a subtle difference. That's important, I think, because ultimately what we're facing here for gold and silver, that's something the analysts just don't seem to get their head around, is that we're facing a fiat money crisis. And we've had like 100 years of that unbacked stuff. And it's finally reaching a crisis point because the focal point now is the U.S. government and Japanese and UK and et cetera, debt markets, their debt. And when you reach that crisis, you've reached the big one. And that's when the issue of fiat currencies comes into question. And already there are movements we know around the world, here, there, in this country, that country, to move more toward a gold-backed situation. And this coming crisis, which, again, I don't see analysts talking about, is going to hit. And when it hits, then suddenly they'll say, gee, that's the reason, huh? Oh, now I understand. Anyway, that's where I think we are, and I think 2026 is going to expose almost all of it.
Oliver's first major point is that silver's move is not being driven simply by an upward trend, because silver and gold have technically been trending higher for years. What has changed is relative performance. Silver is now breaking out not just in absolute price terms, but against gold itself, signaling leadership within the precious metals complex. At the same time, gold and silver are decisively outperforming the S&P 500, and mining equities are confirming that shift. According to Oliver, these are not short-term signals. They are the kind that emerge after markets build bases that last a decade or longer. From there, the discussion moves toward historical precedent. Oliver compares silver's current setup to prior acceleration phases, where long advances were followed by rapid repricing events that unfolded over just a few quarters. Importantly, he emphasizes that these moves were not smooth. They included pauses and temporary pullbacks that shook out weak positioning, only to be followed by even more aggressive upside. This historical lens sets the stage for his deeper analysis of what the next several months may look like, and why investors should be cautious about interpreting volatility as failure rather than confirmation.
If you go back and examine the two acceleration phases of silver that occurred within the old reality, that would have been 1979 to 80, when after years of advancing already at that point, silver exploded. It like quadrupled in a matter of 5 months it was. Went from like $12 to 50, okay? And then in 2010 and 11, again, after years of advance, so it wasn't like some new game, silver doubled in a half in about 7 months. Boom, okay? But in the middle of both those moves, if you micro-analyze them, which we've done, there was in fact a midpoint, what you might call stumble or a midpoint pause or a midpoint correction. It really didn't amount to much other than for a moment in time, making people feel like, oh my gosh, that's the top. But that was only like 3 months into what we define as the couple quarter move. And so sure enough, after that little jig-jag was over, right about in the middle of that clock, they exploded again, even more so than what they'd done in the first half of that clock. So the question now is, let's say we got a signal in the close of November. So let's say this is month 1, 2, 3. So maybe you get to February or so. At that point, we're going to be focused at MSA on trying to define any midpoint stumble. It will be a fake out, but we still know that there's a lot of, including myself, a lot of investors who are positioned in call options, and therefore are sensitive to such fluctuations. So it would be an important thing to avoid if you can, but you don't, as an investor, want to get out of silver at that point. In fact, you don't want to get out of silver, period, even after the 6-month move, because there's a new reality about the dawn. And while price will have made much of its move, the interesting point, though, will be, let's assume the 6-month clock is about right, give or take a month, okay? And again, this happened to copper, it happened to lead, it happened to silver twice in the past 50 years. Where are you going to be at the midpoint of that move? Could be very interesting. Are you going to be 80, 95, let's say $95 to $100? And I picked that because that's a stupid level. Why is that stupid? Because if you take the arithmetic range of the past 50 years and you simply add it to itself, the target would be roughly somewhere close to 100. $50 range added. So it's sort of an idiot technical analysis. What we're arguing is you should do it on a logarithmic scale. And if you take that range that was like $4 to 50 for 50 years and you double it, you double the range on the log scale, which is like a 10-fold range, $4 to 50. You're talking $500. Don't chuckle. The interesting thing, well, where will we be, let's say, about 3 months into this move? Will we be under 100 or will we be well over 100? And then we get a jiggle. Because that sort of sets your dynamics. You think, well, if we got this far in the first 3, good grief, where are we going to be in the next 3? Maybe 200's too low. So we're not certain on where that peak might be in 6 months or so. Although I would argue at least 200. But a lot's going to be told in the next couple months. Where do we go, let's say, within 3 months of that signal?
Do you anticipate a downturn in the stock market? And a lot of people are considering that metals might sell off, especially silver, it having an industrial component here.
No, that correlation, by the way, is a coin toss. We've studied it, put out reports at length going back to the 50 years or so, examining the movements of gold, the miners, etc., during stock market downturns. And the response by gold, the gold miners, silver, it's a little bit different each time, but not always do they respond to sharp stock market downturns. And plus, I say sharp because the stock market could go down and it won't affect silver and gold at all. I mean, you look at 2007, let's take as an example. It peaked in October 2007, dropped November, December, January, February, March. 6 more months passed while the stock market was declining, not collapsing, declining hard though. And gold was continuing up. And miners were continuing up during that same 6-month period. It was only when you got to September, October of 2008, a full year after the bull market peak in stocks, way off the price high, that finally gold and the miners and silver have a very sharp drop that seemed to be correlated to the S&P, although they certainly weren't correlated in that first year of the bear market of stocks. So it's an iffy correlation. In fact, we showed charts in a recent report where back in the 2007-8 period when stocks topped, you looked at wheat, corn, and soybeans and gold. They correlated much better, so you could argue, oh no, gold went down because the grains topped, because they topped also not with the stock market, but later on, like in March or so of 2008. 6 months off the stock market high. So you could almost make a better correlation and say, well, got to watch corn, beans, and wheat because that affects gold. Or is it the other way around? Maybe gold affected them. You get the point. Yes, there can be correlations as far as the stock market goes. I don't think there's going to be a sharp collapse type of event in the stock market until certain other things happen. We've been arguing for the last month that the stock market decline is not going to commence right now because we've already wasted too many months on monthly momentum of the S&P or NASDAQ and trying to go down on those metrics. You get downward readings on momentum, yet price was just struggling sort of sideways for especially the last 3 months. So when we see that waste of time on momentum, where there is a decline on the momentum readings, but no real response by price, then as far as we're concerned, for the moment, the bear clock is over. They've had their chance. We're likely now to see, and we said this in a report 2 weekends ago, you're likely to see further gains in the S&P before you even start to top again.
Michael Oliver's outlook for silver is ultimately rooted in the idea that markets do not remain irrational forever. When a commodity trades inside a range for 50 years, as silver effectively has, the eventual breakout is not about marginal gains. It is about repricing the asset to reflect decades of suppressed valuation. Oliver argues that silver's recent escape from that range is not a speculative anomaly, but a structural reset, similar to what copper experienced when it broke out in 2005 and rapidly quadrupled. In those cases, the market did not drift higher over years. It adjusted violently over quarters and then stabilized at an entirely new level. A critical element of Oliver's analysis is his expectation of volatility within strength. He points out that previous silver accelerations included midpoint pauses that briefly convinced participants the move was over. These pauses were not tops, but resets within a broader advance. If a similar pattern unfolds, Oliver suggests the focus should not be on exiting silver, but on understanding where those pauses fit within a much larger 6-month or multi-quarter repricing cycle. From his perspective, even a sharp correction would not negate the thesis, because the underlying breakout remains intact. Oliver also challenges a common assumption about silver's vulnerability during equity downturns. While silver does have industrial characteristics, historical data shows its correlation to stock market declines is inconsistent at best. In several past cycles, silver, gold, and mining equities continued rising well into equity bear markets, only reacting much later and often for unrelated reasons. His view is that a true crisis, particularly one centered on sovereign debt and fiat currency credibility, would be more supportive than destructive for monetary metals, especially silver, which sits at the intersection of monetary demand and physical scarcity. That broader macro backdrop is central to Oliver's optimism. He sees the current environment as the culmination of a century-long experiment with unbacked fiat currencies, now colliding with unsustainable government debt levels in the United States, Japan, the UK, and beyond. In such conditions, gold and silver cease to behave like ordinary commodities. They become alternatives to sovereign promises. Oliver suggests that this shift is already underway, quietly reflected in the relative performance charts long before it becomes obvious in mainstream narratives. Taken together, Oliver's message is not one of short-term speculation, but of structural change. Silver, in his view, is no longer negotiating within its old constraints. It is discovering a new price reality, and that discovery process is rarely calm or orderly. Whether the next milestones arrive faster or slower than expected, his analysis consistently points to substantially higher levels than most investors are prepared for. If you found this breakdown valuable, support the channel by liking the video, subscribing, and sharing it with others who are serious about understanding where capital is truly flowing. Thanks for watching, and we'll see you in the next deep dive analysis.